Almost $8 trillion is currently sitting inside US money market funds. At the same time, crypto investors keep asking the same question. Why does Bitcoin barely move when the news is good? The answer is simple. The money did not disappear. It found somewhere safer to wait. Markets do not rise because a headline is bullish. They rise when buyers have capital, market makers have room, and enough money is willing to move through the system. News provides the reason. Liquidity provides the force. And once you understand where that liquidity comes from, Bitcoin's most violent rallies and its fastest collapses begin to look far less mysterious. Welcome to Block Docs. Liquidity is often explained as the amount of money in a market. That is incomplete. Liquidity is the ability of a market to absorb buying or selling without the price breaking. Imagine selling one glass of water in a crowded city. There are thousands of buyers nearby. Selling it is easy, and the price barely changes. Now imagine selling the same glass in an empty desert. One buyer arrives with no competition. That single transaction can completely reset the price. Crypto works the same way. When an exchange has thousands of buy and sell orders close to the current price, the market is deep. Large trades are absorbed. Price moves gradually. But when those orders disappear, the market becomes thin. A relatively small order can push Bitcoin hundreds or even thousands of dollars. This means a market can have enormous trading volume and still be fragile. Because volume tells us how much was traded. Liquidity tells us how easily the next trade can happen. And that distinction becomes critical when fear enters the market. Bitcoin trades 24 hours a day, but the money moving it still comes from the wider financial system. Banks, hedge funds, asset managers, corporations, and retail investors must constantly choose where capital earns the best return for the risk involved. When interest rates are low and cash earns almost nothing, investors move further out on the risk curve. They buy growth stocks. They fund startups. They buy Bitcoin. But when safe government debt offers an attractive return, cash no longer needs to take as much risk. This is why the nearly $8 trillion inside money market funds matters. The money is liquid, but it isn't available to crypto. It's earning a return in Treasury bills, floating rate securities, and short-term lending markets. In July 2026, money market managers were shortening the maturity of their portfolios because they were preparing for the possibility of higher interest rates. That isn't a market positioned for maximum risk. It's a market being paid to wait. This is the first mistake many investors make. More money in the financial system does not automatically mean more money flowing into Bitcoin. The location matters. The return matters. And most importantly, the path matters. Capital only affects an asset when it can and wants to reach that asset. Spot Bitcoin ETFs created a new path. Before them, institutions often needed crypto exchanges, specialist custodians, or direct wallet infrastructure to gain Bitcoin exposure. ETFs placed Bitcoin inside a familiar Wall Street wrapper. A portfolio manager could buy it through the same system used for stocks and bonds. This brought new liquidity into Bitcoin, but it also connected Bitcoin more closely to traditional capital allocation. Now Bitcoin competes inside the same portfolios as technology stocks, corporate bonds, commodities, and cash. When money enters Bitcoin ETFs, institutional demand can support the market. When it leaves, that support can disappear quickly. In July 2026, a single day of roughly $181 million in ETF inflows helped Bitcoin recover above 65,000. But one day of inflows could not guarantee a new trend, because an ETF flow is not merely a vote of confidence. It is part of a larger allocation decision. A fund buying Bitcoin may be selling something else, and a fund selling Bitcoin may not have changed its opinion about crypto. It may simply need cash, lower volatility, or a different risk profile. The ETF didn't free Bitcoin from macro markets. It connected Bitcoin more tightly to them. Inside crypto, stablecoins form another liquidity layer. Today, more than $300 billion in stablecoins circulate across blockchains. They allow capital to move between exchanges, trading pairs, DeFi protocols, and wallets without returning to a bank after every transaction. Think of stablecoins as fuel already stored inside the crypto economy. When stablecoin supply expands, more dollar-like capital may be available to trade, lend, or provide collateral. But supply alone doesn't guarantee buying. Stablecoins can sit idle. They can move into lending protocols. They can leave one blockchain for another. They can be held as protection during a sell-off. So stablecoin growth is not automatically bullish. The key question, not simply, how many stablecoins exist? It's, where are they moving and what are they being used for? Because liquidity that sits in a wallet is potential energy. Liquidity entering an order book becomes market force. This is where liquidity becomes visible. Every exchange order book contains buyers below the current price and sellers above it. Those orders form a ladder. When the ladder is deep, price has support. But market makers don't promise to keep those orders there. During calm conditions, they compete to provide tight spreads and deep markets. During extreme volatility, their risk increases. They may widen spreads, reduce order sizes, or remove orders completely. The ladder disappears. Now imagine a large seller entering the market. The first layer of bids is consumed. Then the next. Price falls through the empty space between them. This is known as a liquidity vacuum, and it explains why a crash can occur without every investor selling. The market does not require millions of people to panic simultaneously. It only requires more selling than the available bids can absorb. Leverage makes this system more dangerous. A leveraged trader controls a position larger than the cash they actually deposited. During a rally, this creates additional buying power. The market appears deeper. Confidence increases. More traders enter. But leveraged liquidity is borrowed liquidity. It exists only while collateral remains above the liquidation threshold. When price begins to fall, exchanges automatically close positions that can no longer support their debt. A liquidation is not a trader deciding to sell. It is the system selling for them. That forced selling pushes price lower. Lower prices trigger more liquidations. More liquidations remove more bids. The market enters a loop. Price falls. Collateral weakens. Positions are liquidated. Liquidity disappears. Price falls again. This is why a small headline can appear to cause a massive crash. The headline may only have provided the first push. The real damage came from the structure already waiting underneath. Now we can understand why news produces different outcomes at different times. Imagine Bitcoin receives the same positive announcement in two separate markets. In the first market, interest rates are falling. ETF inflows are rising. Stablecoin capital is expanding. Order books are deep. Leverage is moderate. The news attracts buyers, and the market has enough support to build a sustained rally. In the second market, Treasury yields are high. Cash is earning attractive returns elsewhere. ETF investors are withdrawing capital. Market makers have reduced depth. Long positions are already crowded. The same announcement creates a short spike. Early buyers enter, but there is not enough capital behind them. The rally fades. Late buyers become exit liquidity. The news did not change. The market beneath it did. This is why markets often begin falling before the public narrative turns bearish. Liquidity usually moves first. The explanation arrives later. Crypto liquidity can be simplified into 4 states. Expansion. Cash becomes cheaper. Yields become less attractive. ETF demand rises. Stablecoin supply expands. Market makers provide deeper books. In this environment, rallies can travel further and recover faster. Rotation. Money remains in financial markets but changes destination. It may move from altcoins into Bitcoin, from Bitcoin into AI stocks, from speculative assets into Treasury bills. The total pool of money may remain large, but the winner changes. Compression. Safe yields rise. The dollar strengthens. ETF flows weaken. Market depth declines. Good news produces smaller rallies because less capital is willing to chase them. Cascade. Leverage is high. Order books are thin. One price move triggers forced selling. The market stops behaving like an auction and begins behaving like a machine. This is where investors who only follow headlines are most vulnerable. They see an event, but they miss the structure that amplified it. No single indicator can measure all liquidity, but the system becomes easier to read when viewed in layers. At the macro level, watch interest rates, Treasury yields, the dollar, the Fed's balance sheet, and where cash is sitting. At the institutional level, watch Bitcoin ETF, inflows and outflows. At the crypto level, watch stablecoin supply, exchange depth and spreads. And at the leverage level, watch open interest, funding rates, and liquidations. None of these indicators predicts price perfectly. That is not their purpose. Together, they reveal whether the market has the capacity to absorb a shock or amplify it. The financial world is currently filled with money. Almost $8 trillion sits in U.S. money market funds. More than $300 billion sits in stablecoins. Bitcoin is accessible through institutional ETFs. Capital is everywhere. But liquidity is not defined by how much money exists. It is defined by where that money is willing to go. A headline can attract attention. It can change expectations. It can trigger the first trade. But it cannot create deep order books. It cannot force institutions to take risk. And it cannot stop leverage from unwinding. News tells you what people believe. Liquidity tells you what they can actually buy. Because in crypto, the headline may begin the move, but liquidity decides how it ends.